Hi everyone, and we're going to illustrate the end of chapter comprehensive problem on chapter 9, which is partnerships. And in this chapter we talk about the formation and organization of partnerships. And actually in this problem we're going to have a dissolution, which I think chapter 10, which is actually not going to be part of your reading, but that's another chapter you can deal with later on your own after the course is over. But what I want to do now is illustrate there are two ways to handle this. The first way that we're going to illustrate right now is called the bonus method. The second way is called the goodwill method. Now the bonus method can be considered a bit of a misnomer because you can have a situation where there's almost a negative bonus. So you have to divorce yourself from thinking bonus in the sense of a payment you get for a job well done. That's not what this is about. It's just saying that you're going to hit the partner capital accounts, maybe with a debit or a credit, depending on what's necessary to make the entry rectify or balance. So let's just walk through what we have. Now, you wanted to look at the textbook and look at the debits and the credits on the journal entries that they're doing. But what I wanted to do for illustrative purposes and for lecture purposes is show this in a spreadsheet format, kind of a macro picture to show all the ins and outs and how each partner capital looks with the columns. So you can see I've got on screen right now the spreadsheet with the initial two partners by the names of Heyman and Mullins, and what they agreed to do at the outset, and they tell you this in the book, is they're going to contribute various things, and it shows you which one which each person contributed. And I have those along this row 5 where you've got they assumed a note payable. There also was cash and an inventory building, and notice that the inventory and the building were contributed at the market value, not at book value. Since you're forming the partnership, the book value on whatever books it was is completely irrelevant. So you have to take a look at the market value and bring them onto the books of the partnership at that value. So you can then see that what our what our assets are with cash, inventory, in the building, and then you've got a note payable as a credit to offset that, so a net of $90,000 right there in cell G5. And they specifically say that they will each be credited with an equal share of that. Now that does not pertain to the profit and loss split, which also is given in the problem, that they would split profits and losses 60-40. So I've noted that up here. So this is the initial setup on row 5, and the book then shows that in a journal entry format, but basically I'm showing it here in a spreadsheet table format. Now the next event that happened was on October the 1st, and Heyman invested an additional $12,000 of cash, and so you see that coming into his capital account, and the cash here on this column, keeping track of the assets. Now one thing to pay attention to is I am not trying to show all of the trial balance and the debits and credits because they don't give you that kind of information. These are just placeholders out here so you don't get confused and you can see what's happening on the flip side of the transaction. But don't hold me to the fact that we don't have a complete trial balance exhibited over here. This is what you need to be paying attention to, are columns C through E. Now, what does and we strike a balance here then at on October 1st after that cash contribution. So now Heyman's capital account has gone up by the $12,000 contributed. But why do we care about that? Well, the reason is we get down here and we look at the bonus calculation and how that's supposed to happen. And if you look at the problem, it says that for managing the business, Heyman is credited with a bonus of 10% of partnership income after subtracting the bonus. Now, what you need to do is pay attention to the algebra on that, because it almost sounds like a circular type of a problem or a do loop, if you remember from your programming classes. But in this case, we're going to have to take, and you just look at my formula here where I'm saying C25, which is the income, and the income for the year of the partnership was given to you. So we're going to take the income times 10%, but this division by 1.1, I want you to see the algebraic steps that are done on page 444 of the book, about 2/3 of the way down the page. And it's pretty simple high school algebra, so it shouldn't give you any kind of a difficulty. And all I've done is then committed that to an Excel formula right here. See that then gives you the bonus of $3,000 that you will then credit to Heyman. Now you see the bonus coming in on his capital account on this column. Now we've got to deal with the interest. What did it say about the interest? It said both partners are entitled to interest equal to 10% of the average monthly capital balance for the year without regard to any income or drawings for that year. So Mullins is pretty straightforward. And if we go down a little bit further, that I'm saying Mullins' average capital for the full year, average monthly, was $45,000. The reason I say that is nothing happened. It just the initial investment, and then there was no other than the drawings. And they said to ignore the drawings, but there was no other additional capital contribution or capital withdrawal other than the drawings. So so it stays at $45,000 per month. So it's very straightforward. At 10% is $4,500. Now, what about Heyman? Well, what we have to do is say he went for 9 months, from January through the end of September at $45,000, and then we had the injection of $12,000. So how do we deal with that mathematically? And you can see here that I'm taking the 9 months at the $45,000, and then I'm looking at 3 months at the $57,000 to get a total, and then I'm dividing that total by 12, and then I find out there's an average monthly of $48,000 at 10%, gives $4,800 as the interest allocation. So there you see the interest allocations coming in for both partners. And I'm doing a tally of both partners here in column G, so you can just kind of keep track. Now, what about the income allocation? That, they said, was if we take the $33,000 of net income and then back out the bonus and back out the interest calculations, and you see all this coming down to $20,700. And then if we go at a 60-40 split of that amount, you can then see that there's $12,420 going to Heyman and $8,280 going to Mullins. So I'm taking those amounts from down here that you can see on row 44 and bringing them up to here and to your income allocation. Now, what about the drawing accounts that happened? Well, the book says that they drew $800 a month for 12 months, and so you can see that there. And that's typical in a partnership where you have to have money to buy groceries and pay for the car payment and so forth. So a partner will then just draw out, and they're going to live on that money. That's not considered a salary. It's not something they're going to get through ADP and their payroll. That's just a drawing of cash out of that business, and they're free to use it what they will. And you remember from your textbook that the income of the partnership is going to flow through to the partner's tax return on Schedule M. So, you know, don't confuse this drawing with a salary. That is not what it is. Now, but it is, in fact, though, a reduction of their capital accounts. You see the $9,600 coming out of each capital account respectively. So Heyman then is down to $67,200, and you can see my formula that's going from row 7 down through row 11. And then on Mullins, a little bit simpler, but again, I'm just taking a summation down, straight down the column. And that gives me then capital balances at the end of 2012. So other than a little bit of fancy algebra on doing the bonus calculation and a little more algebra on the interest calculation, there's really not that much of a problem in this first section. Now, where it gets a little bit sticky is on the January 1st of 2013, we have a new partner coming into the business named Lewis. And Lewis, an employee, is allowed to join the partnership on January 1st of 2013. The new partner invests $66,000 directly into the business for a 1/3 interest in the partnership property. Now, look what's happening. We've got $66,000 coming in, an injection of cash. And what that does is that entitles Lewis then to a 1/3 ownership of the partnership. So what is the partner's capital at that time? And that's what I've done in column G, is after the $66,000 injection, you're at $181,800. And so he is allowed then to get a 1/3 interest in that amount. So you can see in this formula, I'm taking G17 times 1/3, and that's the $60,600 that he is credited. So the difference between the $66,000 of cash that he put into the partnership and then what he's credited for on his capital account of $60,600, there's a $5,400 difference. So what do we do with that? We have to keep our debits and credits equal, and so this is really, if you want to think of a bonus in the sense that the capital account is going to increase for Heyman and Mullins, and what they're going to do is they're going to share respectively, and you notice in this formula I'm using the 60% for Heyman and the 40% for Mullins, and they are then sharing in that difference. So the sum of these two, let me just paint over those, and you can see that's the $5,400 there that's coming into those partnership capital accounts for those two respective partners. So then what I did next on row 17 is just struck a balance, and you can see Lewis remains at $60,600, and now I've got the this, if you want to call it a bonus allocation between Heyman and Mullins of that of Lewis's entry into the partnership that then causes their capital account to increase. Now, the book says, a few years later. I love how it fast forwards and doesn't give you any details on that. So this is why, obviously there are things going on. There's net income being recognized and so forth. And so don't, again, get hung up in what's going on over here on the right-hand side of this illustration. But what are we talking about then, the event that we have to account for? Well, it's a withdrawal and a payout by Mullins. And then you're going to remember the book talks about when you have a withdrawal of a partner, you basically have a dissolution of the partnership. The operations go on, but legally the old partnership is dissolved and a new partnership forms, and so then we'll have a new partnership agreement. Now, when Mullins pulls out, what happened is they were paid, or he, she, whoever, was paid $90,000, and look what's happening. They're sitting there with a capital account of $78,000. Now, it's a matter of negotiation as far as what the amount that they're entitled to get upon withdrawal. And the book talks about maybe you have an appraisal done, but there certainly could be a contentious type relationship there to settle on how much that is. Now, the accounting for it is you're going to zero out, of course, you're going to zero out that partner's capital because they are now gone, and you dissolve the partnership. So there's the $78,000 coming out, which was simply the balance that Mullins' account was at the time of withdrawal. And then there's the credit of cash that I'm showing over here. Pardon me, didn't mean to make you dizzy there. The credit of cash in that column. So what did we have to do with it? Well, at this point, now Heyman and Lewis remain. They both have a 40-40 split. Well, that might as well read 50-50 because there are the only two remaining partners. And so they're going to have to take a 50% share of that $12,000 difference, the $12,000 between the $90,000 payout and the $78,000 capital balance of Mullen, and then we'll split that $12,000 evenly between Heyman and Lewis, and then you see their respective subtotals at the end. So, and then at this point there would be a new articles of partnership, and life would go on with Heyman and Heyman and Lewis being a 50-50 share, and whatever they agree upon as they go forward. Okay, so I hope that helps illustrate the bonus method, and so the next video will show the goodwill method of handling these transactions. Thank you.